When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the market's most unpredictable stretch, September through November, also sector and style rotations, where we're seeing opportunity. We'll answer listener questions, and then finally, beyond stocks, where fixed income and commodities come into play. My name is Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and the solid advice, they come from the other Jeff in this radio program. It is Jeff Hogan of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm always doing good when I'm with you and the listeners here on the radio show. Like it. It's fun, and I'm sure we got a lot of really cool things to talk about today, like always.
Yeah, we really do, Jeff. I'm excited for today's topic, and as always, we're certainly glad to be with our listeners here in the greater Tucson area. Jeff, as we round the corner into fall, the kids aren't the only ones going back to school. It's also, I think, a time to do a checkup on your investment portfolio. Today, I wanted to break down what investors should expect and how tactical planning can help our listeners stay one step ahead. What are you focusing on as we head into September, and what is September historically in the market?
Well, if you look at historical averages, September is really kind of a bad month, but you also have to factor in the fact that September's, you remember 9/11, that was a bad September. We've had crashes in Septembers and Octobers. Seems like November, the market either gets happy again till the end of the year, but it's not every September. It's not every October. I mean, we had over 3% growth in the market and all the indexes in August, but I think it was all the indexes were up at least 3. And typically August is the second worst month of the year behind September. So, you've got averages to take into play here. I think because of the horrible Septembers we've had in the past, it kind of skews down the averages and it makes us think like every September is going to be bad. I don't think it will necessarily be bad. I think the things that we're not seeing is really the solid economic underpinnings of a market that's doing as well as it's doing or not. In other words, the economy really isn't supporting it, even though they're cheerleading it and saying everything's good on the news. But it's only good for rich people who can afford high interest rates, who don't need to buy houses with loans. But for the regular person who can't afford to sell their home because they can't get a new mortgage at 6 or 7% to get another house, they're kind of feeling stuck. First home buyers are feeling stuck because they can't get into homes. Even though gas prices are down a bit, it still seems like food and some of the staples are still going along at about an inflationary clip of around 3%, which is higher than the 2 that they want. And honestly, there's not that many good fundamentals for a lot of stocks around there. We've got some stocks, the Magnificent Seven, led by NVIDIA, make up about 50% of the S&P gains so far year to date. I think NVIDIA by itself makes up 30+% of the gains of the S&P. So one stock is driving it. So we're not really seeing the breadth that we would like to see. But because interest rates are still kind of high, even though the producer price index didn't come out higher than they expected, it still came out higher than is wanted. Consumers are paying more for stuff, and inflationary signals raising interest rates, not lowering them. And so even though Powell said we're leaning towards lowering interest rates and the market assumes that there's one, and they probably priced it in already and then some, they probably priced in 2 or 3 interest rate decreases. But the thing is those are all short-term interest rate decreases, overnight Fed funds rate, that kind of thing. So it's not going to affect mortgages. It's not going to affect credit card delinquencies and mortgage delinquencies and all the things that are really not looking that strong in the economy. So we've got to go into September with a bit of concern. If they don't lower interest rates and make the market happy, we might see a backlash. The other thing that scares me is how much margin buying there is. I mean, everybody's borrowing on the margin. They'll loan you 3 times the amount of stock. If you own $100 worth of stock, they'll loan you another $200 to buy more stock. And if the stock goes down and you get scared and you have to sell out because you're scared of getting a margin call, or you have to sell because you don't want to lose 3 times your money instead of just the money that the stock gives back, then you sell. And that more people sell, it exacerbates the problem, and people see the price going down even more. And then there becomes a selling frenzy. And that's when crashes happen, and you can't really stop it, especially when there's so much tourist money, a tourist meaning the tourist investor who doesn't really look at fundamentals, who just kind of listens to people on TV and says, oh, that's a hot stock, let's buy that one, or oh, this one's going up, it's a meme stock, or hey, what about GameStop? Let's go get it. It's going to 300%. I mean, there's just a lot of hype that isn't supported by fundamentals, and that scares me. And I've been saying this for a few years now. I mean, I've been saying that as long as I've been in this business, is you've got to be careful and make sure that, kind of like the trust but verify idea, trust the market's going up, but verify why. Is there some fundamental reason that it's going up? Is there growth in a particular industry that makes certain stocks or certain sectors of stocks a good buy or a good value? Yeah, maybe there is. I think there's still some areas that we can find that, especially as the AI business gets going. The problem is not all AI companies are going to emerge winners, just like all .coms didn't go through the roof. We've got like 7 or 8 .coms that made it through that era. Everything else crashed. And now we've got 5 out of 7 of them are the Magnificent Seven. So yeah, the strong will survive. The weak will go by the wayside. And unfortunately, too many people have money in so many of those flyers that they may lose. The other thing is when there's mass sell-offs with, even though 7 stocks are doing well or holding their own, they're going to sell off too. And if they sell off, then it exacerbates the downtrend in the indexes, and that creates fear, and that creates a big sell-off. So we have to be careful about that. I still think you shouldn't have money in the market you can't afford to lose. Even though the market's going up, doesn't mean it will always go up. Doesn't mean it's not due for a correction. It's been due for a long time. The corrections that are due always happen. We just never know when. So keep that in mind. And some people think, well, why can't it just keep being overvalued forever? It's been overvalued this long. Why can't it just keep being overvalued? Why can't they keep printing money? Well, they can't really keep printing money because printing money creates a problem. You have more and more debt to service. And with interest rates as high as they are, especially when you have to refinance debt with long-term interest, if we could refinance debt, if Jerome Powell would lower the short-term interest debt to 2%, but we could refinance all the debt at 2% every 3 months, that would be different. But we can't. Typically, it's the 10-year bond yield that we're looking at. And we're looking at a whole bunch of debt, trillions of dollars of debt that's coming due that has to be refinanced, that has to be bought out because those bonds are coming due. When those bonds come due, people are going to get their money back on the $1,000 they paid for that bond. They made low interest, but now guess what? They want higher interest, which means they are going to have to get issued bonds or buy them at a discount for the same amount of money that it costs to service our debt a year ago, or let's say 5 years ago, is going to be 3 times that. What they'll have to come up with to just service the interest payment on the debt, which means we're going to dig a debt hole faster and faster. And that doesn't look well for the future. Again, I'm not a doom and gloom guy, but let's keep reality in check here. Let's keep it in mind. There are some things that are troublesome. And, if you look at the next 2 months, September and October, they typically are the months where if there is going to be a crash or correction, that seems to be the months they choose. So let's beware. Let's be cautious. Doesn't mean we can't make money in the right stocks. And if we're vigilant, we can get out in time when there's a market sell-off. It looked like there was maybe one starting last week. Didn't really carry through too hard during the first of the week. Although tech stocks are selling off, we've got some of those things that are a little overvalued are finally coming back to reality. We've got record insiders selling, meaning that the CEOs of the companies are selling at record paces. And we've got the street investor that doesn't know a whole lot. We call it dumb money. The ones I referred to earlier as tourist investors that are buying them up because on their Robinhood account, they see the dip and they want to buy the dip because it's been working for the last few years since they had a few dollars in the market. And they think that's just the way the market works forever. Well, some of those dips are not just dips. Some of those dips are 50% corrections or crashes like 2000 and 2008, which took more than 5 years for that market to return to its previous high. So we're looking at like a 7-year cycle if the market sells off like it has before. History does repeat. We can't set that aside just because the recent few years has been better or different. It doesn't mean that cycles don't repeat. So again, September, kind of a scary, worrisome month. People are back from summer vacation. Sometimes we have a little summer lull. There is an old saying that in May, just go away. And that's because the trend in the summertime is usually flat, and there usually ends with the September and October that are typically, or more often, not good than good. And then get back in November. And there are some strategies where some investment managers are only in the market between November and May because those historically are the best times. So you can play the odds or you can play the current market. The odds combined with the current market might be the better way to go. And that's the way we treat money. Is the odds are that the market, going to have its worst month in September, October. So we have to be a little extra vigilant and a little extra cautious, maybe take a little bit less risk, maybe be a little bit more jumpy if the market does look like there's going to come a sell-off, not just, we'll just hold and ride it out. Because if you hold and ride it out and there becomes this big, huge, basically margin call sell-off, that's going to create a situation where it's not just the dip that bounces back. It's going to create a situation where it's a dip when nobody has more money to invest, or only the rich people have money to invest. Of course, they're going to buy all the stocks cheap, and everybody else is going to be too scared to get back in or too broke to get back in. And that's where the middle class lose in the stock market and the rich keep getting richer. So we want to be on the side of the rich. We want to keep getting richer. We at least don't want to be losers. We don't want to be the typical middle class, unsophisticated investor, the uninformed investor, the one that thinks that they can hear the news and be their own great advisor, their own do-it-yourselfer. Those people are the ones that by and large get in trouble more often. And that's who we try to help stay out of trouble, because it's not so much about the money you make. It's about how much you don't lose. Not losing money, especially if you're approaching retirement, is more important than hitting home runs, especially when the odds are you can strike out more often than hit home runs.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the current market events. Again, our telephone number, 520-780-9059. If you would like to request an appointment with Jeff in our Retirement Roadmap series and sit down with Jeff, talk about your retirement portfolio. Maybe you want to talk about the market, anything that you want to talk about that will affect your journey towards a confident retirement. Jeff can talk about that. All you've got to do is call 520-780-9059 and request your appointment. No cost and no obligation to that. Okay, Jeff, let's continue our conversation here. November's outlook. Let's talk about that. November is one of the strongest months of the year, often setting the tone for year-end rallies. Where are you seeing opportunities here for the rest of the year? And where should we be looking to focus our investments?
Well, I think every day something changes in the news as far as what new policies might be taken center stage with the Trump administration and so forth. He's really good at tipping his hand, though. So, I mean, he'll at least tell us whether it's energy, whether it's AI, whether it's chips, whether it's whatever industry that the government supports with taxpayer dollars is typically industries that do well, or at least with the support of the White House. So we can kind of read something into that. But as far as the next 2 months, like I said, they're, historically weak, but that doesn't mean they always will be weak. We had in 2018, we had a really good market correction at 25% or better in December. It was kind of the end of the year rally. And that year we didn't have a bad September, December. So you have to take each year by itself, by its own merits. Just because November's historically a good month, November tends to be a good month because after a beatdown like some Septembers and Octobers have provided, September's a great bounce month. So you have that, again, the average returns being affected by one or two really good bounce years after a market correction. So if you look at just every month overall and use kind of a different philosophy of how many Augusts have been down compared to how many Augusts have been up, rather than what's the average rate of loss in August or September or October, which typically are the 3 months that people look at as being the worst years of the month. Are they always that way, or do they always perform badly only if the prior 8 or 9 months haven't been bad? Or could we say, well, we had a nice correction in March and April, and we've bounced back from that over the last 6 months. Maybe we don't need a crash in September and October. And if we have a really good September and October, I'll bet you November is not going to be the gangbuster month. It might be the month that you take profits and lock in gains for the year rather than try to earn money and have hedge fund managers and mutual fund managers do what we call window dressing by buying their favorite stocks that are cap weighted or that make their fund looks better so that they can show great returns at the end of the year. And that's why we call it a Santa Claus rally typically, because at the end of the year, that's during Christmas time. But a lot of hedge fund managers and Wall Street, by and large, manipulates the market in their favor to make themselves look good by the end of the year. Could work both ways. If we've had a really good year, sometimes it's profit taking. They'd rather lock in a good year rather than take a chance on the market sell-off and not being first out. And so it kind of depends what the market's doing. If you look at the money and follow the money, that's where a good advisor who spends a lot of money like we do on research and data so that we know where the money's going, where the money's flowing, and what's more likely to happen than not is probably a good idea and probably worth paying a fee to. So some people like doing it themselves, but they have no information to trade on because they like to save a fee. If your advisor is actually paying attention to the market and spending money on the information that Morningstar, hedge fund managers, and banks are spending money on, and we get the same information, then we can make decisions that are in line with what the smart money's making. And that typically gives us an advantage. Doesn't always make us win, hands down, but it does give us an advantage. Individual stock pickers are doing better right now, including our own funds. Our individual stock funds are doing better than our ETF or exchange traded funds, because exchange traded funds or mutual funds have a ton of stock in them, maybe in a particular sector, but all sectors aren't doing super well at the same time, or all stocks in that sector aren't, but there are some that rise and shine and some that are kind of muted and don't really have great, robust returns. So again, where sometimes you get the more steady play with the exchange traded funds or mutual fund models, it's not happening right now, which kind of gives me a little bit more of an indication that the market's weak, the breadth is weak. and you've got to be even more careful. But those are some of the things that you ought to take into consideration when you decide to get in the market. You want just a good diversified portfolio that you can close your eyes and not worry about? Or are you going to be watching it every day and getting out of harm's way when it looks like harm's coming? Do you have a long-term investment horizon? Are you a day trader? Are you going to be needing this money in a few months or a few years to live on? There's so many things that go into how you should invest and what type of investment you should make. But between now and the end of the year, typically we see a variety of different conditions, just like we do every year in different months. But historically, and if you want to go by the odds are if we're going to have a big meltdown or a correction, it'll happen this month or next. And a lot of smart people are calling for that. This recession or the crisis that has been long in waiting will probably happen the third or fourth quarter of this year. Well, we're just getting ready to end the last month of our third quarter and start the fourth quarter. So are they going to be right? I don't know. They've been calling for it for the last 2 years. I've been on their side most of it because a correction is long overdue and it will probably happen. We don't know when, but just be wary, be cautious, and be aware of what could happen. Interesting. I just saw an interesting report about the fishing game announcing that up in the mountains, I have a cabin up in the mountains on the rim, and it says you have to be more bear aware. When I heard that term bear aware, I thought that's like the stock market this time of year because, the bears are getting ready for hibernation. They're coming into the neighborhoods, getting fat and stuff, and we have to be bear aware and be careful. But we also have to be bear aware of the stock market because this is that same time frame. I just thought that was an interesting correlation. Gave me a chuckle over the weekend when I heard that.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Again, we're talking about the markets. 520-780-9059 is our telephone number. If you'd like to have a conversation with Jeff, just a casual conversation to talk about your retirement portfolio and what September through December may bring for you. Once again, that number, 520-780-9059. Jeff, let's continue our conversation here. I think chasing sectors without understanding how they affect your tax exposure, your income streams, your estate value can backfire. For example, you're sitting on a large gain in tech. Do you rotate or do you consider tax loss harvesting or even gifting strategies tied to those holdings?
Well, there's a number of things you can do. Now, if you're trading a lot in a non-IRA account, you're going to have the buys and sells and the gains all associated with it. If you're trying to make money, let's just say if because you can take profits and trade and not just buy and hold and be so worried about the taxes that you never sell when the market goes down. I mean, if the market goes down 20%, you could have sold, pay 20% in taxes and you're still in the same place than if you sell when the market goes down 20%. Oh, but wait, if the market goes down 20%, you not lose 20% on those gains. But guess what? You also lost 20% of your actual money. You still have to pay tax on the rest of the gains. So is it really tax efficient or is it really smart not to worry about taxes? Well, you can in so much as you don't have to worry about the taxes in a tax deferred or a tax qualified account like a Roth or an IRA. So if you're going to do a lot of trading or rotation, it's typically best to do in those things. If you really don't want to have the tax hits and you're willing to just look at your long-term money or maybe some dividend stocks, are going to be paying 4 or 5% dividends a year. You don't really care what the stock goes up or down. Maybe that's what you have in the non-qualified or the non-IRA stocks so that you already pretty much have a handle on how much taxes you're going to pay at the end of the year. And then, of course, if there is time when you feel like, well, the market's really up, it's really high, I made a lot of money on these stock holdings, maybe I should sell some. Is there something you could do with a tax loss harvest? Or can you give those appreciated stocks to your church or charity at an appreciated value and not take the gains on your own personal tax return, but also give them to a charity where they don't have to pay tax on those gains and you get credit for that charitable gift? So again, there are some ways you can play the game, especially if you do have charitable gifting in mind. That is one of the ways we can get rid of some of those problems. You can also offset just by being smart tax-wise. When you're old enough, over 70, you can do those direct contributions to charities from your IRAs, so you don't have to count the required minimum distributions or any withdrawals on your IRAs towards your top-line income. They can actually miss the top-line income and actually never show up on your tax return if you do that correctly. So there's a lot of little strategies we can use. But again, it kind of depends what you're looking to get. If the net bottom line is, I had to pay taxes, but I made 1 or 2% more than I would have made had I just held out and sold later, or just not sold or not taken and used that money, then is that really an advantage? You have to weigh that. I think sometimes we get so caught up in, I don't want to pay taxes. Sometimes it's better to just pay taxes as you go or just pay taxes on your gains, because then you have to worry about deferring them and letting them kick you in the butt later on a higher number to higher amount. There's a difference between ordinary income and long-term capital gains treatment as well. So short-term capital gains are different than long-term capital gains. There are some tax-efficient funds and models that are tax-efficient, but honestly, as I look at them, they are typically the underperformers of the group. And you would have to be in the top tax bracket to have them actually benefit you just from a tax standpoint. And you'd have to guarantee that in the future, sometimes you'd be in a lower tax bracket in order to take advantage of those tax savings while you were in the higher tax bracket. So again, everybody's situation is a little different. I think although we can make an overall planning strategy that's very tax efficient, save hundreds of thousands of dollars, sometimes even millions of dollars in taxes over someone's lifetime if we do things efficiently. But when it comes to trading in the account, if it's growth, trying to make money, earning high dividends and interest, things like that, that grow your net worth net of taxes, then taxes again are the secondary, I guess, condition that we look for. First, it's how much can I earn on a net basis? That's really what it comes down to, is if I pay taxes, can I be more aggressive and make more money? Or I really don't want to go into a new tax bracket. I really just hate taxes so bad that I don't care if I make a little bit less. It's within my value system to just be calm and cool about the tax situation and maybe just worry about it later. Again, we try to look at things in advance. We try to look at them decades down the road and make sense out of when it makes sense to pay more taxes, maybe now on less money, than pay more taxes later on more money at a higher tax bracket. Your tax situations definitely should be taken into consideration. There are some tricks to offset some of those sales. Like you said, tax loss harvesting, sell some of the losers to offset some of the gains. Maybe you've got a tax loss carry forward from a property or a stock you sold years ago that you just really haven't used up yet. So you might have some room to sell and do things. Many people come in and they've had mutual funds for a long time and they think, oh, well, I bought these so long ago, I probably have a huge tax hit. Most mutual funds trade so often that you actually get the pass-throughs of those taxes as you go, and you might find out that you don't have as bad a tax situation as you think. And so it's important to have someone that understands taxes, that doesn't disclaim tax planning as in their practice, like so many broker-dealers. Almost everybody does. We don't disclaim it. Shoot, we have CPAs that work for us. We have a very good knowledge of taxes and how they impact your investments. And although we can't say we give tax advice, we do plan around taxes, and we do understand the tax code enough to not get you into tax trouble and to make plans that are tax efficient for you. So again, I'm not going to claim to be a CPA or an attorney, but we work with them and we get our answers and our suggestions and our strategies validated by those people who are qualified to make those legal and qualified declarations.
Well, taxes, of course, and healthcare are two of the biggest expenses that you'll face in retirement. And as you said, we're not necessarily tax accountants. We're not CPAs, but we do have a synergistic relationship with a number of CPAs. And of course, if you do have a CPA, we can work with your CPA as well, too. We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, we've been talking about September through December. September, not the best month for finances. October, though, I remember 1987, 2008. Those were some pretty bad times in financial history, too. So I think really you should look to us if you're looking for someone who can maybe make some sense of all of this. If you're looking to preserve your wealth so you can have a better retirement, if you want to create income streams that you can count on, if you want to reduce taxes, we may have the answer for you here at Premier Retirement with our Premier Retirement Roadmap. To get yours at no cost and no obligation, call 520-780-9059. It's 520-780-9059. Make that call right now. Shelley will call you back during the week and set up your appointment at no cost, no obligation. 520-780-9059 or online at premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll answer listener questions. And then later on in the program, we'll be talking about beyond stocks, where fixed income and commodities come in. When our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
Thank you so much for joining us each and every weekend for Premier Retirement right here on 790 KNST. I'm Jeff Shade alongside Jeff Hogan, and we've had a very valuable conversation today about the market, the economy, where we're heading into here in September through December. If you've missed any part of that program, we're also a podcast. Go to wherever you get your podcast. You'll hear that part of the program, also our past programs, so you can stay on top of your journey towards a successful retirement. If you just want to hear us on the radio, we're on 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. right here on 790 KNST. Our phone number, 520-780-9059. If you'd like to get in and sit down with Jeff, talk about anything that affects your confident retirement, we can talk about that, no cost and no obligation. It's a chance for you to get a second opinion, or first, if you don't already have a plan. We call it our retirement roadmap, and we would love to begin one for you. Again, no cost. 520-780-9059. Okay, Jeff, time for listener questions. Charles is listening to us here in Tucson. Charles says, I've been listening to your show for about a year, and I get a lot of good information from it. My question is about the retirement roadmap that you offer. I'm 65 now and have about $1.5 million in retirement savings. My Social Security will be $3,000 at full retirement age next June when I want to retire. How do you design this roadmap for me?
Well, it just kind of depends on a lot of your goals. You've already given me some of the information as far as the income that's guaranteed. What we have to do is take the income that you have saved and those other resources that you can turn into income or turn into savings and growth, depending on what your annual needs are. So it's not really rocket science, but it's very individualized. I mean, we have a spreadsheet that we go through. I mean, how much is your required or desired lifestyle going to require to live on? And let's make sure that that income is secure. You have your Social Security and assets that can be converted to create income. So once you know that, then you have the discretionary items. Do I want to risk the rest, or do I want to just create more guaranteed income to have more peace of mind and more confidence in my retirement? Do I have a situation where I have so much in my IRAs and 401ks that I have a tax problem and that I'm going to have to deal with in the future? What are some of the things that I want to do that might cost a chunk of money down the road? Is it short term? Is it long term? How long do we have before we deal with those big expenditures? Do I have enough reserves for those emergencies and that kind of a thing? So, I mean, the process is pretty much the same. You listen to me on the radio and I just do all the talking, but when you come in, hopefully we sit down and you do all the talking, and then we develop a plan and we explain that plan to you. You digest it and we tweak it until it makes sense. The roadmap is really not just, oh, you have this much risk. We need to dial back your risk because you're retired now and we're going to reinvest and we think we can make this much money for you. I mean, that's what everybody else does, but we actually give you a spreadsheet that has the future 30 years on it. That gives us an indication of where we ought to be, should be, with very conservative assumptions. So if the stock market averages 10 over time, and we might put a stock market return of somewhere between 5 and 6 average rate of return. We might put a 3 or 4% average rate of return on something that's more of a fixed type of an account, even though those typically we can do better on those things. So we make some assumptions. We take your information, we put it out in a big old spreadsheet, show you the plan. And yeah, if it looks like you're going to run out of money in 10 years, then we need to tweak the plan and either have you spend less or find more money someplace. If we find out that we have way more money than income and you have way more than you want to die with, you think, well, shoot, I can maybe have a little bit more fun now. Maybe we go on some more trips with the grandkids. Maybe we do some things that we weren't planning on doing. Anyway, the fact that you have $1.5 million in retirement savings probably means you have a tax problem coming up in about 7 or 8 years, maybe 10 years from now, and you've got a decent Social Security. But that $1.5 million, if you look at the Wall Street model, will generate about $60,000 in income. We'll probably show you on a guaranteed basis, you could probably keep $5 million in play and still have that same guaranteed amount of income and not have to worry about the other $500,000. With the Wall Street model, you might run out of money in 25 years if the markets don't perform. So again, we like to take the risk off the table. We look at the overall picture, what you want to accomplish, what you can live on, see if it's reasonable and see how much you need. If you're living comfortably on $3,000 and you have a bunch of kids you want to make rich, maybe all you do is you take out your required minimum distributions when you get old enough and give them to a charity and let everything else ride for your kids. But I'm guessing that most people want to spend a little more than $3,000 a month. You'll want to do something more with it. I didn't get whether you're single or married. It sounded like you're single. So it's just really up to you what you want to do with your money. If you want to spend it every last dime, you want to save a lot, you want to do a little bit of both, just get a nice, comfortable income. I'm sure if you have $1.5 million in savings, I'm sure you're making 6-figure income in your job or so, and maybe more than that. And you probably want to maintain that type of a lifestyle. So I think taking some of the risk out of that retirement savings or that 401k, if it is in risk, would be one of the priorities to start talking about, and then just divide it up into different accounts that'll generate income and accomplish the goals you want.
And Jeff, Charles says that he's 65. If he's in good health, there's a 50% chance probably that he'll live to be about 95. So that could be a 30-year retirement. Charles, thanks so much for that question. If you would like to get started with your retirement roadmap, again, no cost, no obligation, 520-780-9059 is our telephone number. Let's move on, Jeff, now to Lou, who's listening in Green Valley. Lou says, my wife and I have started giving money to my sister to help her out. It's going to be about $30,000 a year for the next 5 years or so at least. Will this sum be more than the amount the IRS allows us without triggering federal gift tax paperwork? Do we have to be careful to not give more than the one-person limit from a separate checking account? Our finances are joint and we file a joint tax return, but I have a separate checking account and I make any Zelle and Venmo payments from there.
Well, the only time you have to really worry about that gifting rule is if you're trying to lower the asset base in order so you don't end up having to pay estate taxes on that money. Right now, you and your wife both can gift more than enough to cover the $30,000 on a per person basis to that sister. So you're not going to have to file anything. You're not going to have to worry about that anyway. You're certainly not violating any gifting limits. And depending on your estate, that gift tax paperwork is basically just a statement saying, hey, we gave this much money away. Don't take it out of our unified creditor estate tax non-taxable limit when we die. Most people aren't going to hit that. Maybe you will. If you've got $10 or $20 million in assets, you probably got to pay attention to this kind of a thing. If you've got $1 million or $2 million, like most retirees nowadays have, it's not going to be an issue. I think it's awesome that you're in a position to help your sister out. That's awesome. I'm sure she's appreciative of that. But helping pay somebody's bills is an important thing. And it's not going to, I don't see a situation where it's going to affect you on an estate tax basis.
So, Jeff, I think for gifting, it's about $19,000 a year here in 2025 per person. Yeah. But the lifetime, isn't it like almost $14 million, something like that? So when they give away $30,000 a year, it just goes towards their lifetime limit. But at $13.99 million, they've got a ways to go.
It doesn't go towards their limit because they can freely gift up to 19 per person. So their 38,000 is way more than the 30. So it's not going to affect them at all. They're going to keep every bit of their unified credit.
Oh, I see. I see how it works.
That $30 million limit is only on the amount that you gift over and above the.
I see. So you can gift the 19,000, but that doesn't count. It's whatever is over the $19,000 goes towards your lifetime limit.
Yes.
Lou, that's a very good question, and you set me straight in a few things, too. We appreciate you listening to us there in Green Valley. We'll send you out Jeff's book, Retirement the Road Ahead, and our number 520-780-9059. Good point, Jeff. Donna's hearing us in Casa Grande, and Donna says, my children inherited $5 million in stock from their father, whose estate hasn't yet been dispersed after 11 months, leaving them with a 30% tax loss of value over which they had no control. Is there a way that they could choose which equities to sell and harvest tax losses? It's my understanding that the 10-year individual retirement account withdrawal period is now reduced to 9 years, which makes it even more taxing.
Well, I'm wondering why it hasn't been dispersed after 11 months if they're the beneficiaries. So it says that they inherited it. They really haven't inherited if they haven't received it yet. They don't get a step up in basis on that if it's in an IRA, if that's what you're indicating, it's an individual retirement account with $5 million. Just because the stock went down doesn't mean it can't go up in the next 10 years, but at the same time is one of the pitfalls of probate and why we recommend living trusts or at least direct succession beneficiaries being listed. In other words, if your children are listed as beneficiaries on the account, they should be able to have already made the request to have their portion dispersed. Now, if your children are minors, they would have to do that with the adult or whoever's in charge or their guardians help, which I'm assuming would be you. But let's say if their father dispersed it over, depends on your age. I don't see any ages here. I'm looking at the question. That kind of limits my understanding and ability to answer clearly. But bottom line is, if it's tied up, then you're subject to the losses or whatever the market deals out. Now, there should be an executor or an administrator over that account, and you should have a say-so and say, hey, look, can we just put that in cash while we let the market do what it does so that we can at least inherit what was left there, the $5 million instead of the 30% loss? I mean, that looks like a $3.5 million now. That really stinks. Must be in a lot of bonds or a lot of highly appreciated stock that just hasn't done well. But that also goes to show that just because the Mag 7 and the couple of big stocks like NVIDIA keep going up doesn't mean the market's healthy. If you can have a 30% loss in the last 11 months, that just speaks to how scary the market is and how risky the market is and how somebody who's retired who can't afford to lose 30% of their assets shouldn't be all in the market. You know, your children at least have that 9 years to get it back. I guess the benefit of having it go down 30% is if they did pull it out and pay taxes on it, they could reinvest in tax deferred or tax efficient assets and not have to pay those income taxes on 30% of that money. So in and of itself is not all bad. I mean, there is a tax deduction if you could reinvest in something that has some growth opportunities to get that money back in a after-tax manner so that it doesn't just grow back 30% just so you have to pay a third of that in taxes when you pull it out. Then, that might actually work in your favor. So let's try to squeeze some lemonade out of the lemon here and make it a little sweeter than it is. That is one benefit of that scenario that may actually help you because it's not like the money's lost. I mean, if the stocks or bonds went down, typically over time they'll recover. And if they do have to pull them out and they reinvest it rather than pull them out, pay taxes, and then not reinvest it and just spend the money, then yeah, it does lock in a loss because you just spent the losses and locked in the losses. But again, reinvesting, or if there's some way, if you have enough savings to pay taxes on those withdrawals over the next 8 or 9 years, then maybe you set up a disbursement plan where you pay taxes over that period of time, or even give yourself an exact payout amount through some sort of an annuitization type plan and reinvest dollar cost averaging into it over the next 8 or 9 years. And you'll probably find out in 10 years, you'll have more money than you started with.
Donna, that's a good question. Thank you for listening to us in Casa Grande. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. And as always, you can call Jeff at 520-780-9059. That's also the number that you'll use today. You're listening to the program and you like what Jeff is talking about. You'd like to sit down and talk to him about your portfolio. It's a casual conversation, no cost and no obligation. 520-780-9059 is our number. You can make that call right now. Jeff, let's shift gears here a little bit. Earlier, we were talking about September through October and then on through the end of the year and the things to expect here. Wanted to talk a little bit about investment strategy for the rest of the year and possibly beyond that, 2026. Beyond stocks, where do fixed income and commodities fit into a portfolio?
Well, it depends. Right now, commodities like gold and silver are becoming a nice hedge against the risk in the stock market. There's also certain industrial value to gold and silver. And since they are in limited supply, the world's only so big a place and there's only so much, and it keeps being mined so we can use it in its industrial application. So it does actually have real value, unlike, I'll say, Bitcoin or something that just becomes a password out of thin air that somebody just made up and all of a sudden it becomes money. Gold and silver are a commodity that actually has value. It actually returns value and can be used in something. So can oil, and so can a lot of things that would be considered commodities. Food, for example. I mean, you can't get through life without food. Food's a commodity. There are some times when you can invest in different sectors of commodities, or certain times of year that certain things go up and down: sugar, coffee, corn, that kind of a thing. Some people play the market and actually play the commodities market. I don't think the lay person investor typically does that kind of a thing, but there are ways that do play the commodities. There's ETFs, exchange traded funds, that might be into different sectors of the market, like energy sector or even the nuclear sectors, the different specific kinds of energy. There might be different kinds of consumer staples or consumer goods, or gold and silver, palladium, platinum, uranium, all those different commodities may be traded kind of like stock in the form of exchange traded funds. You can also buy stocks in individual companies that mine gold, silver, and those other things. Do they all have a place in your portfolio? My opinion is wherever the money's going and whatever has a chance to make money is a good thing. If that particular investment also pays a dividend or gives some sort of guaranteed growth somehow, that makes it maybe a little safer, more palatable to own as we try to dial in our risk tolerance and make sure that we're not getting outside of what's comfortable for us. But there's all kinds of different strategies. My opinion is, just because some people have, this is your short-term bucket, you're going to have CDs and cash in there, that's going to last you for a year. Then we have the medium-term bucket, we're going to put a whole bunch of 1 to 3 year bonds in there and a few dividend stocks. Here's your 10-year bucket, we're going to put stocks because we're not going to touch this bucket. Well, how do you know you're not going to touch that bucket? I mean, maybe you will, maybe you won't, just depending on what you need. And then here's your long-term, leave it for my kids bucket, we'll just park it in some stock, set it and forget it, and not even think about it. Well, I mean, that's one easy do-it-yourself way to do it, or kind of a passive way to invest if you want to do it that way. If you have an active advisor that actually manages stock accounts, when the market's healthy and when there's opportunities, we try to take advantage of them, whether it's 6 months, 6 years, or 6 days. When those opportunities manifest and when the odds are in our favor, if we're in just a kind of a hunker down and wait mode like we were most of the last couple of years, just because of the excessive risk and the uncertainties and the overvaluation of the market, which is there. But at least we have someone in the White House that tips their hand and says what's important to the country and what we're investing in and what the country's behind. So with that in mind, we have a better chance to pick those sectors in the market that make more sense. And one of the things that we're seeing is the world in general, big central banks, I mean, China, other countries, central banks are buying up gold and silver, mostly gold, and driving the price up. We've got $3,400 an ounce gold that we've never seen before. And it's been up there for about 6 months or so in that range, over 3,000. It may still go higher. Some people think it'll be 5,000 by the end of the year and even 10,000 in the next 5 years per ounce. Maybe it will, maybe it won't. But the fact is there might be some opportunities if the market's sketchy to diversify, like our portfolios have done, into more of a retirement mix where we have a little bit of hedges going on so that when the market sells off and the smart money flies back into bonds, which they eventually will do, and they're already hedging with some commodities like the gold and silver market, we get a little bit more of a smooth ride instead of a more bumpy, choppy ride when those turbulence come.
To your point about commodities, Jeff, I think that oil and gold, industrial metals, even agricultural plays here can be affected by the tailwinds from the Fed positioning and supply constraints. But when we talk about fixed instruments, and we talked about those a little bit, what are some of the fixed instruments that you might use?
Well, we like fixed instruments that aren't even stock market instruments. I know they call fixed income bonds, but the bond market's down 20 or 30% depending on how long a bond you bought. The only bonds that have been safe are anything less than 3 months long. Shoot, I just looked a couple of days ago. I opened up the market just to see what the 20-year bond was. Down 1.2% in a day. It's down like 25% in the last year or so. It's bounced a little bit trying to go up, but it's just really not picking up any steam, which means interest rates on the long term, anything 10, 20 years long, is going up. That's why mortgage rates aren't falling. They've fallen a little bit just in expectation that the Fed might lower interest rates, but they're not going to lower 10-year, 20-year bond rates. And I think banks, just to be competitive, have to lower the rates a little bit or else they won't loan anybody any money. And that's really the catch-22 of it, because the bond market in and of itself, there's a lot of people that aren't trusting the U.S. bond market because of the debt service coming up and the unknowns ahead, is that the bonds are getting a little bit weak. The dollar seems to be a little bit weak, but interest rates keep going up. That usually makes dollars stronger. It makes the bond prices, or it makes the investments in interest-bearing accounts more secure. You know, if you've got money in the bank, CDs are still paying a decent rate. That's a fixed account, probably a little bit more secure than a bond. At least you know the duration. It's a short duration typically, and you know what you're going to get at the end of the road. I also like fixed annuities, and I like multi-year guaranteed annuities. We can still push the high 5% right now for something 5 to 10 years long. If you want to just lock your money into something that you know you're not going to lose, you're going to make some money. It's tax deferred till you need the money out. You only pay taxes on the interest when you pull the money out and use it. And that'll beat a CD. So we like the fixed accounts that are more guaranteed. The insurance companies will take the risk on the bond market. You don't have to. And although they're less liquid, most people who have hundreds of thousands of dollars, maybe even a few $1 million in a retirement account, aren't using all that over the next year or two anyway, or even the next 5 or 10 years. So if you want some long-term money that, I said before, some people just say, oh, your long-term money's got to be in the stock market because in 10 years, we know that the market will be up. Well, we don't know the market will be up in 10 years. We have the crash in 2000 and the crash in 2008 and the lost decade of 2000 to 2010 where the market made zero. It just kept going up and down and crashing and recovering and crashing and recovering. It didn't even get back to its original point for 14 years. So it was 2014 before the market actually stayed above its highest point in the year 2000. So there's no guarantee that the stock market's going to be better over the next 10 years. In fact, if you look at the Shiller adjusted price earnings ratio, and it's a cyclical adjusted, CAPE, cyclical adjusted price earnings ratio, it means that in a 10-year cycle, if the price earnings ratio is where it is right now, the following 10 years typically only generate about 2% rate of return at the max, and negative is probably more average, because when the market is overvalued the next 10 years, typically there's going to be some corrections. They give it a whole 10 years to play out. It's not like, oh my gosh, there's going to be a correction. It's got to happen in the next quarter. It'll probably happen in the next 10 years. So why not lock up some of your money, the long-term money that you think might only make 2% in the stock market? Why not lock it up for 5 or 6 right now? You can, or at least maybe split the difference. Say, well, at least half my money I know is going to be worth at least 30% more than I start with in 10 years, or 60% more than I start with. So my overall portfolio is at least going to be up 20 or 30% in 10 years, even if the stock market ends up flat. The stock market tears it up, then great. I make money on the stocks and I still make money on the guaranteed portion. So we like fixed accounts. We like fixed instruments, but we don't like fixed instruments that are necessarily Wall Street risky, because even stocks and even bonds, those what they call fixed income investments, are not safe. They still lose money. Most people's portfolios that I see coming in, they're wondering why the market's up and why their portfolio is not up. Because the bond contingent in their portfolio is dragging it down. Everybody has 30 or 40 or 50% in bonds, and they're going down, down, down. And they're wondering why 3 years ago they had $1 million. They're using a little bit of that, and the market's up 20% each of the last couple of years, and they're still at $1 million. They're wondering why we didn't spend $300,000 or $400,000. We only spent like $60,000 out of this, and our market is still the same. Why? Because bonds drag it down. Fixed income securities can drag it down. But fixed annuities or fixed index annuities, we like it using the annuities that are principal protected that only go up. You can either guarantee the rate they go up, or you can take a chance on making double-digit returns, or somewhere between 0 and double-digit returns on any given year. So it's up to you how you want to skin the cat. But for our fixed products, for our guaranteed money, we like those things that are actually guaranteed, that are secured, that are insured, and have more levels of insurance and security than anything you can buy on Wall Street. For those things that want upside and risk and keep liquid, we like Wall Street. We're respectful of it and a little fearful of it right now, to be honest. But the fact is, it's still generating some good returns for those people that are willing to risk a portion of their portfolio. And we're actually navigating the sea of the market pretty well right now. But having said that, that could change any time. There's no guarantees in the market. It could flip on you and make you wish you never got in. But at the same time, if you do well, you're sure glad you did.
Jeff, we began the show talking about September through December, what to expect, the fall effect. For those people just joining us, can you summarize that in just a minute or so?
Well, I wish I had a crystal ball and could tell you. The fact is, every fall and every end of the year is a little bit different. Even though the odds favor bad months in September and October, doesn't mean we're going to have them. And it means we could have really bad ones. If we have bad September and October, typically we have a good November, December. We have a really good October. Sometimes we have a mediocre November and December. If you look at the last 5 or 6 years, there's really no rhyme or reason as to when it happens or why it happens. Fact is, you've got to be nimble. You got to be watching the market. Hopefully you have somebody that's insightful and can look into it like we do as advisors. That's what our job is. If you want to delegate that worry and research, then somebody like us would probably be a good place to start.
520-780-9059 is our number. You're listening to Jeff Hogan of Premier Retirement. And again, you're hearing the program today. You'd like to sit in and have a conversation with Jeff on a casual basis. Certainly, we would love to do that. We call that our retirement roadmap. 520-780-9059 is the number to call to get yours at no cost and no obligation. Make that call today. Jeff, we're out of time for this week. Thanks so much for your time, but I also want to thank our fine listeners for joining us here in the greater Tucson area. So for Jeff Hogan, I'm Jeff Shade, wishing you a great weekend. Thanks for listening. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.